You just got pre-approved for a $650,000 mortgage. Your real estate agent is excited. The bank says you're good to go. You can finally afford that 3-bedroom house you've been eyeing. There's just one problem. At current rates, your monthly payment will eat 42% of your gross income. The bank doesn't care. They approved you anyway. And if you sign those papers, you'll spend the next 30 years wondering why you can never get ahead, why every month feels like you're drowning, why that dream house turned into a financial prison. Welcome to the affordability crisis nobody's talking about honestly, and it's about to get a whole lot worse. My name is Alex, and I've spent the last 8 years analyzing Federal Reserve data, commercial real estate trends, and housing market dynamics so you don't have to wade through the jargon and panic-inducing headlines. And what I'm seeing right now is a perfect storm brewing for 2026 that almost nobody understands correctly. Not a collapse, not a crash, something different. Something that requires you to understand what's actually happening rather than just bracing for disaster. If understanding real market dynamics instead of clickbait fear helps you make better financial decisions, make sure to hit that subscribe button and give this video a thumbs up. Here's what we're dealing with. The housing market isn't on the verge of some catastrophic meltdown like 2008. But commercial real estate? That's a different story. And the gap between what people can afford and what homes actually cost has reached levels that would have been considered impossible a decade ago. The question isn't whether there's a crisis. The question is what kind of crisis it is, who it affects, and what you should actually do about it. And I'm going to show you exactly that. But first, you need to understand the numbers everyone's getting backward. Let's start with residential housing, because this is where most of the confusion lives. You've probably heard that homeowners are sitting on massive amounts of equity, that most people own their homes outright, that the housing market is rock solid, and there's truth in those statements. But they're hiding something critical. According to the U.S. Census Bureau's 2024 American Community Survey, median homeowners with mortgages now spend 21.4% of their gross income on housing costs. That's up from historical norms and approaching concerning territory. But here's where it gets interesting. If you want to buy a median-priced new home today, which costs $419,200, you need to earn $97,800 and dedicate 38% of that income to housing. 38%. The HUD standard for affordability is 30%. We've blown past that by over 25%. Let me put that in perspective. Historically, the typical American family spent around 25% of their income on housing. We've now jumped to 38% for new buyers. That's not a housing bubble about to pop. That's a structural affordability problem that locks people out of homeownership entirely. And here's the thing that should terrify you. 77% of U.S. households cannot afford a median-priced new home at current income and rate levels. Not because they're financially irresponsible. Not because they're not working hard enough. Because the math simply doesn't work anymore. The game changed, and most people are still playing by the old rules. Now, I know what you're thinking. What about all those people who already own homes? Aren't they fine? And yeah, mostly they are. 66% of Americans own homes according to Census Bureau data. About 35 million households, which is roughly 40% of all homeowners, own their homes free and clear with no mortgage at all. That number went up by 900,000 from 2023. So if you're in that group, you're insulated from most of what's coming. Your payment isn't changing. Your equity is real. You're not the problem. But here's what nobody's telling you. That affordability gap I just mentioned, it creates a lock-in effect that's quietly strangling market liquidity. And that matters even if you already own. See, during 2020 and 2021, mortgage rates dropped to 2.7 to 3.5%. Millions of people refinanced or bought at those rates. The Federal Reserve was buying mortgage-backed securities hand over fist, keeping rates artificially low. Now those same people are looking at 6.5 to 7% rates if they want to move. Which means selling your house and buying another one would literally double your monthly payment even if you bought the exact same house somewhere else. So people aren't moving, they're staying put. Which reduces inventory, which keeps prices high, which makes affordability even worse for anyone trying to get into the market. It's a vicious cycle, and it's being driven by Federal Reserve policy most people don't even know exists. We'll come back to that. But first, I need to show you where the real danger actually lives. And it's not in residential real estate. The commercial real estate market is staring down a maturity wall that makes 2008 look like a minor correction. And I'm not being hyperbolic. According to the Mortgage Bankers Association's February 2025 report, $957 billion in commercial real estate loans are maturing in 2025. That's a 3% increase from 2024. S&P Global Market Intelligence projects the maturity peak hits 1.26 trillion in 2027, with 936 billion maturing in 2026. Let me say that again. Nearly $1 trillion in commercial real estate debt coming due in the next 12 months. Over $1.5 trillion by the end of 2026. Now here's why that's a problem. Most of these loans originated between 2015 and 2017 at interest rates of 3 to 4%. Refinancing rates right now? 6 to 7%, depending on property type. That's not a minor adjustment. That's doubling or tripling your borrowing costs overnight. Imagine you own a commercial building. You took out a loan 7 years ago at 3.5%. Your debt service was manageable. The property was cash flowing. Everything was fine. Now that loan is coming due. You need to refinance. But the new rate is 6.8%. Your monthly payment just doubled. Except your tenants aren't paying double rent. Your income didn't double. Your property value probably dropped because nobody wants to buy commercial real estate at these rates. So you've got 3 options. Inject a massive amount of new cash to cover the equity gap. Bring in equity partners and dilute your ownership. Or default and lose the property. Those are the choices facing hundreds of billions of dollars worth of commercial property owners right now, and it gets worse. Because not all commercial real estate is created equal. The office sector is in freefall. National vacancy rates are hovering near 19 to 20%. CMBS delinquency rates, that's commercial mortgage-backed securities, for office properties hit 11.31% according to TREP's December 2025 data. Compare that to the overall CMBS delinquency rate of 7.3%. Office is nearly double the average. Cities like Austin and San Francisco are showing the highest distress. And this isn't temporary, this is structural. Remote work permanently reduced demand for traditional office space. Companies realize they don't need 60,000 square feet when half their workforce is home 3 days a week. Leases are ending, tenants are downsizing or leaving entirely. And property owners are stuck holding buildings that generate 30% less income than they did in 2019. You can't refinance your way out of that. The fundamentals are broken. Now, before you panic, let me add context. Office properties represent only about 10% of the total commercial real estate loans maturing in 2024 and 2025. 10%. That's significant, but it's not the whole market. Industrial properties, medical office buildings, data centers, those sectors are actually doing fine. Strong demand, solid fundamentals, investors are still interested. Multifamily is showing mixed signals. We'll get to that in a moment. What I'm about to show you next is the thing that took me years to figure out. Because the way this crisis is unfolding is completely different from 2008, and if you don't understand the difference, you'll prepare for the wrong disaster. 2008 was rip the band-aid off fast. Subprime mortgages imploded. Lehman Brothers collapsed. Credit markets froze. Everything happened in months. This time, we're pulling the band-aid off slowly, and that's a direct quote from an MSCI analyst describing the current situation. Banks had been postponing defaults through loan modifications and extensions since 2022 and 2023. It's called extend and pretend. Lenders don't want to foreclose because that means recognizing losses on their balance sheets, which tanks their stock price and triggers regulatory scrutiny. So they extend the loan for another year, modify the terms, hope interest rates drop, and property values recover. And for a while, it worked. The Federal Reserve cut rates by 100 basis points in 2024. Property owners thought relief was coming. Except long-term rates, the ones that actually matter for commercial mortgages, increased by an equivalent amount. Short-term rates dropped. Long-term rates went up. Borrowers got exactly nothing. And now the extensions are running out. First quarter 2025 saw distressed commercial real estate assets hit $116 billion. That's a 31% increase year over year. The extend and pretend strategy is collapsing under its own weight. Lenders are running out of road to kick the can down, and when they finally stop extending, foreclosures spike. We're already seeing it. Nearly 150 commercial real estate foreclosures happened in the first half of 2025. That's the highest mid-year total since 2014. MSCI expects 60% of apartment loans originated in 2021 and 2022 to mature in the second half of 2026. If those borrowers can't refinance, and many won't be able to at current rates, we're looking at a wave of multifamily foreclosures hitting right around this time next year. So yeah, the maturity wall is real, the distress is real, but it's unfolding in slow motion, which gives you time to understand it and position yourself accordingly. Now let's talk about the banks, because this is where systemic risk enters the picture. The Kaplan Group identified 278 banks in 2025 as vulnerable due to having more than 50% of their loan portfolios concentrated in commercial real estate. 50% or more. If commercial real estate defaults spike, these banks face serious capital problems. Not all of them will survive. We're not talking about JP Morgan or Bank of America. We're talking about regional and community banks that lend heavily to local developers and property owners. If a bunch of those loans go bad simultaneously, you get bank failures. FDIC steps in. Depositors get made whole up to the insured limits, but credit availability in those regions contracts. Small businesses can't get loans. Real estate transactions freeze. It becomes a localized credit crisis even if the national economy is fine. And here's the kicker. CMBS delinquency at 7.29% is nearly 6 times higher than traditional bank loans. Why? Because CMBS loans were packaged and sold to investors who have zero relationship with the borrower. A bank that originated the loan and knows the borrower personally has incentive to work things out. A CMBS bondholder in Singapore doesn't care. Default means foreclosure. No negotiations, no extensions, just liquidation. And that's why CMBS distress is spiking faster than portfolio loans. If you've made it this far, you're already ahead of 90% of people who just read headlines and freak out. But don't stop now, because what comes next is where you figure out what this actually means for your money and your future. Let's talk about the Federal Reserve's role in all this, because it's massive and almost nobody understands it. The Fed holds approximately $2.3 trillion in agency mortgage-backed securities as of June 2024. That's about 25% of the entire MBS market. Now, that's not a recent thing. They accumulated these holdings during the 2008 financial crisis and the 2020 pandemic through quantitative easing programs. They bought mortgage-backed securities to keep rates low and stimulate the economy. It worked. Rates dropped. Housing boomed. But now they're stuck holding this gigantic portfolio, and they're trying to shrink it through quantitative tightening. They're letting $35 billion per month in MBS roll off without reinvesting, slowly reducing their footprint. Here's the problem. 90% of the Fed's MBS portfolio has coupons below 4%. Those are mortgages originated when rates were super low, which means the homeowners who have those mortgages are locked in at 2.7 to 3.5%. They're not selling, they're not refinancing, they're staying put. Because moving means giving up that incredibly valuable low-rate financing, and that lock-in effect is one of the reasons housing inventory is so tight and prices remain elevated even though affordability is terrible. So the Fed is trapped. They want to shrink their balance sheet, but the mortgages they hold aren't prepaying because nobody wants to give up a 3% mortgage. And they can't just dump them on the market without crashing MBS prices and spiking mortgage rates even higher. They're stuck managing this slow bleed for years. And every month they hold those securities, they're influencing the housing market in ways most people don't even realize. This isn't some abstract central bank policy. This is the reason your neighbor isn't selling their house even though they want to move. This is why inventory is low. This is why prices aren't correcting even though affordability is at historic lows. The Fed's portfolio is an invisible hand holding up the housing market and choking off supply simultaneously. Now let's get into what 2026 actually looks like. Not the clickbait version, the real version based on verified data and reasonable projections. Commercial real estate, particularly office and some retail, faces genuine distress. Foreclosure activity is already rising. More is coming. Banks with high CRE concentration face pressure. Some will fail. CMBS delinquencies will continue climbing because those loans have no workout flexibility. Multifamily is the wild card. Transaction volume is actually up 39.5% year over year, which suggests investors still see value. But delinquencies are rising to 6.64%, so you've got buyers coming in at distressed prices while some existing owners are defaulting. That's a market in transition. It's messy, it's painful for some, but it's not Armageddon. Industrial, medical office, and data center properties remain robust. Strong fundamentals. Consistent demand. Those sectors will be fine. For residential housing, the risk isn't mass foreclosure. Homeowners are in a relatively strong position. Underwriting standards are way tighter than pre-2008. People have significant equity. The average homeowner isn't getting foreclosed on. The problem is affordability for new buyers. If you're trying to enter the market right now, you're facing prices that require 38% of median income. That's not sustainable. That's not healthy. But it's also not a bubble about to pop. It's a market that's priced out most Americans and will likely stay that way until rates drop significantly or incomes rise dramatically, neither of which is happening soon. So if you're a renter hoping for a crash so you can buy cheap, I hate to break it to you, but that's probably not coming. What's more likely is a slow grind where prices stay flat or dip slightly in some markets while affordability remains terrible for years. Here's what this means for you specifically, because abstract market analysis is useless if you don't know how to apply it. If you own your home with a fixed-rate mortgage, you're largely insulated. Your payment won't change. Residential market dynamics are different from commercial. You're fine. Just don't give up a low-rate mortgage to chase a slightly bigger house unless you've done the math on what that payment increase actually costs you over 30 years. If you're trying to buy, understand that affordability is your main challenge. Don't stretch to 38% of your income just because a lender approved you. They're approving you because they can sell your loan, and it's not their problem if you can't make the payments in 3 years. Use the 30% threshold. If a house requires more than 30% of your gross income, you can't actually afford it, even if the bank says you can. Consider less expensive markets, or wait for the rate environment to improve or increase your income. Those are your real options, not hoping for a crash. If you work in commercial real estate, finance, property management, or construction, understand your employer's exposure. Companies focused on office and retail are going to have a rough few years. Diversified companies with industrial, medical, and multifamily exposure will fare better. If you're on the office side, update your resume and start building options. I'm not saying quit tomorrow. I'm saying don't be surprised if layoffs hit your sector. If you're an investor, distressed commercial real estate assets will create opportunities for those with cash and patience. Properties that can't refinance will sell at discounts. But you need to understand what you're buying. A distressed office building in San Francisco isn't a good deal at any price if there's no tenant demand. A distressed industrial property near a growing logistics hub might be a gold mine. Know the difference. Here's the thing everyone misses. Real estate markets move in cycles. Always have. Always will. We just went through an extraordinary period where rates dropped to near zero. The government flooded the economy with stimulus, and housing prices rocketed. Now we're dealing with the hangover. Rates spiked to combat inflation. Commercial borrowers who locked in cheap debt are facing refinancing at double the cost. Residential buyers are priced out. This isn't some unique apocalypse. It's the predictable consequence of policy whiplash. The 2008 crisis happened because lending standards were non-existent and fraud was rampant. Subprime mortgages with no documentation, negative amortization loans, liar loans where you just made up your income. None of that exists now. Underwriting is strict. Borrowers have equity. The residential market is fundamentally sound, even if it's unaffordable. The commercial market has genuine stress, but it's concentrated in specific sectors, and it's unfolding slowly enough that smart players can navigate it. But here's where the psychology matters, and this is the part most financial gurus skip entirely because they're too busy selling you courses. The real risk isn't the market. It's your reaction to the market. If you panic and make emotional decisions, you lose. If you ignore everything and pretend you're immune, you lose. The smart play is understanding where genuine risk exists, where you have exposure, and adjusting accordingly without overreacting. Commercial real estate, particularly office, is genuinely risky. If you're invested there, reduce exposure. Residential real estate for owner-occupiers is relatively safe. If you're thinking about buying, run realistic affordability numbers and don't stretch. If you're already locked in at a low rate, recognize that as a valuable asset and don't give it up casually. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The $930 billion maturity wall isn't a number that exists in isolation. It's the result of decisions made 7 to 10 years ago when money was cheap and everyone assumed rates would stay low forever. Those borrowers are now facing a world where their assumptions were shattered. Some will refinance successfully. Some will bring in equity partners. Some will default. The ones who survive will be the ones who understood their risk, maintained liquidity, and didn't overlever. The ones who fail will be the ones who assume the good times would last forever. And that's the lesson. Not just for commercial real estate investors, for everyone. Assuming current conditions will persist indefinitely is how you get destroyed when the cycle turns. And cycles always turn. The Federal Reserve's $2.3 trillion MBS portfolio will take years to unwind. That means the lock-in effect, the tight inventory, the elevated prices, those aren't going away next month. They're structural features of the market now. If you're waiting for a return to 2019 housing dynamics, you're waiting for something that's not coming. The game changed. Adapt or get left behind. The 77% of households that can't afford a median-priced home? That's not a temporary blip. That's the new reality until something fundamental shifts. Either rates drop by 200 basis points, or incomes rise by 30%, or home prices fall by 25%. Pick one. Because without one of those three things happening, affordability stays broken. And none of those three things are likely in the next 2 years. Almost there. But before I wrap up, I need to show you how all of this works together and what you actually do about it. Because information without action is just entertainment. And you didn't watch this far to be entertained. You watched because you want to know what to do. So here it is. Build an emergency fund. 6 to 12 months of expenses. Non-negotiable. Whether the commercial real estate market implodes or stays stable, you need liquidity. If you work in a CRE-exposed industry, lean toward 12 months. If you're in a stable government or healthcare job, 6 months is fine, but have it. If you own commercial real estate investments like REITs or crowdfunding platforms, review your concentration in office properties specifically. If more than 20% of your CRE exposure is office, reduce it. Rotate into industrial, medical, or diversified funds. Office is a falling knife right now. Don't try to catch it. For home buyers, run your numbers using the 30% threshold, not what the bank approves, not what your real estate agent says you can afford. 30% of your gross income. If the payment exceeds that, walk away. I don't care how perfect the house is. You're setting yourself up for financial stress that will ruin your life. For current homeowners with rates below 4%, understand that moving means giving up incredibly valuable financing. If you're thinking about relocating, calculate what your new payment would be at current rates. Then ask yourself if the move is worth an extra $1,000 or $1,500 per month for 30 years. Sometimes it is. Often it's not. Run the actual numbers before you decide. And finally, stay informed but avoid panic. Commercial real estate challenges are real. The maturity wall is real. Distress is real. But $930 billion in maturities doesn't mean $930 billion in losses. Many properties will successfully refinance. Many will restructure. Some will find new capital through private credit markets, which raised $137 billion through 430-plus debt funds since 2020. There are options. It's messy and painful, but it's not the end of the world. The key is distinguishing between genuine risk and manufactured panic. Office CRE in San Francisco? Genuine risk. Your owner-occupied home with a fixed-rate mortgage? Not risky. Buying a house at 42% of your income because rates might drop later? Risky. Waiting to buy until you can afford 30% or less? Smart. The ability to make those distinctions is what separates people who build wealth from people who get churned by every market cycle. And right now, we're in a cycle that punishes over-leverage, rewards liquidity, and requires you to understand the difference between residential and commercial dynamics. If you understand that, you're ahead of 99% of people reading headlines and freaking out. So what's the next topic you want me to dig into? Commercial real estate distressed opportunities? The Federal Reserve's balance sheet? How to actually calculate what you can afford? Drop it in the comments. That's what this channel is for. Cutting through the noise and giving you information you can actually use. Your future financially secure self is counting on you to make smart decisions based on real data, not panic or wishful thinking. The maturity wall is real. The affordability crisis is real. But neither one is a reason to freeze or make emotional decisions. Understand the risks, adjust your strategy, and keep building. That's how you win.